Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. I drew 6 weeks ago an early July to mid-November 2023 bearish Andrews pitchfork, which I've since highlighted in purple on my daily chart. At the time, it was a way of expressing the bearish angle of attack here, more than that for anything else. And in this, it has been accurate in showing the way lower and the bearish angle of attack, though I still do note, as I have done in all my commentary since I drew it, how prices have stayed away from the upper and lower tines since its creation. Currently they are 1251 and 1064 respectively. Instead, the market has chosen to stick fairly closely to the middle tine, currently at 1157. During the move down, the market experienced some hesitation in January. This hesitation created a small descending wedge pattern over January and into February, which you can see highlighted in dark blue on my daily chart. Maybe just the aesthetics of it, but the way the descending wedge pattern sits made it look like it was pointing the way lower. This observation does not back up this idea, of course, it's just an observation. However, it had been accurate in this instance until 3 weeks ago, when the market departed at a more acutely bearish angle lower, which held. This move lower soon hit supports, notably the December 2020 low at 1143, holding and then turning the market back up late 2 weeks ago, and ever since. This turn upwards was both surprising and amazing, as we really had no further support below until the 61.8% absolute Fibonacci line at 1106. So from the December 2020 low, prices turned back up, pushing congestion in 1161 area, then at 1177 to 1161, and this week at 1193. This doesn't stop the bearish Andrews pitchfork from still ruling this market, but it does raise the question as to whether we may be seeing the beginnings of a strategic change. Today we are set to challenge the first of many key resistances as I speak. It is the declining short medium moving average, currently at 1207, highlighted in green on my daily chart. Beyond this we have the December 2021 low at 1223, then congestion at 1243 before we start looking at the purple upper tine. And that will be a real situation to watch, as the one thing such a move higher might start is discussion if the November 2023 today action is a potential descending scallop pattern. The only thing to bear in mind is not here on this daily chart, but in Chicago soybean meal, and that is the well highlighted annual key reversal down we saw here for 2023. Not directly related here, but not worth ignoring either. Chicago soybean meal. After establishing a horn top in mid-November 2023, something I'd cautioned about 16 weeks ago, prices dropped down through some major supports, and in the process of heading lower, created two lagging indicators, dead crosses, of the short medium moving average, currently 350.90, down through the long moving average, currently 393.20, and down through the medium moving average, also currently 382.70. In mid-January, prices hit the congestion zone 363.70 to 368.80, and this was where I had cautioned 14 weeks ago we might see some hesitation due to the low we saw back in October 2023. Well, prices sliced through this congestion, but in the process the erosion there caused another hesitation, this time between the original congestion band overhead of 363.70 to 368.80 and the next smaller congestion band below around 349.20. This hesitation was formed over January, but broke down in the early part of February, We then had a small area free from congestion until the small congestion seen at 342 even, and then again further congestion below between 336.30 and 338.10. This latter one contains the 61.8% absolute Fibonacci line at 336.30. After a first attempt lower 4 weeks ago, the congestion support gave way in the middle of the week, 3 weeks ago, and dropped down to the next congestion below that at 326.90. However, this congestion was different. As we have crossing through it, the extension to the lower trend line, currently at 326.90, of the July to September 2021 descending triangle. I've highlighted this trend line in dark blue on my daily chart. Now, as I said 2 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since November last year, that this may, just may, see some hesitation around the 327, 325 zone. I'm not certain on that, but it is worth considering. However, the overall pressure is still bearish. You must now consider the congestion in January that ran into early February as a possible bearish halfway hesitation." And that's the end of that quote. Now, the question I had asked last time was, and I quote, "Where to measure it from?" The most obvious is the immediate point is the uptick in late December, to which it would provide us with potential down to just a little under where we are now in the low 320 zone. However, if we were to consider the move starting at the high in November last year, then there is potential down to the 270 zone, well below the bottom of my daily chart. It's too early to say whether the 270 zone will become a target or not, but it is worth considering, and that's the end of the quote. So what did we have in the way to halt any decline? Well, to be frank, not much. We have the October 2021 low sitting very much on its own at 309.30. But we really didn't have much else until we ran into this congestion from 2020 between 300 down to 282.20. So pay special attention to any moves down to the 309 zone. And then any moves below it should we get there. However, the market is, I suspect, fully aware of this, which is why we have seen, for the last 3 weeks, hesitation between roughly 323.30 up to the 61.8% absolute Fibonacci line at 336.30, and even beyond to the congestion at 342 even. It may be the market is getting a touch of, as I said last week, it may be the market is getting a touch of anxiety about all of this, or as I prefer to call it, the heebie-jeebies. We shall see, but as other oilseeds markets are starting to make strategic changes, maybe something should also be happening here as well. Finally, I will raise once again the one key feature I need to repeat and emphasize, as I've done so in the past. I raised it as a possible feature 39 weeks ago, and it came to fruition at the close of 2023. It was that the whole of 2023 was an annual key reversal down year. This hangs over all this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. In early December last year, prices broke out below the 4-week-old bull channel formed in November. The move lower was not as easy as it was back in the big move lower back in autumn 2023. Eventually, at the start of the year, the market broke down through the 38.2% Fibonacci line at 48.95. We had the opportunity to form a very extensive bearish halfway hesitation, with the bear channel being one leg and the bull channel being the hesitation, with the potential being as low as below 40 even. However, the decline, and we had a decline, has been a lot shallower than in autumn last year. This was possibly being dictated on top by the now shallow declining short medium moving average, currently 46.99, that is highlighted in green. Prices went down to the area of congestion we last saw in May 2023, consisting of 3, possibly 4 bands. These are 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2023 low at 44.68. Then the 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, which has the neckline of the October 2019 to February 2020 head and shoulders top running just above it, currently at 42.94. I mention all of these because some 36 weeks ago and numerous times since, I said the following about the big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following, and I quote, "I would consider the descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." End of quote. This is a big pattern idea, and the market decline since autumn of last year fits in with this idea, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 to 46 zone, which is where we've recently been. I'm now keeping a very, very close eye on this idea, as any significant breakdown below 48, 46 could signal the start of the rest of the move lower. As I said last week, and I quote, "So far I'm not convinced of the move, but we've seen this break low already." No, not just yet. However, 3 things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date. So do not expect any immediate sharp moves. Secondly, data indicates that about 3 out of 4 times the market breaks lower. Just be aware of that. Finally, I would like to float the idea of a recent unusual bear channel. End of quote. Now, I've highlighted the bear channel, which is dating from the start of 2023 in dark blue on my daily chart, currently 43.19 to 48.03. I also choose to highlight the declining short medium moving average in green, currently at 46.99. There was some pedigree in this moving average, as it had capped the market in late November last year, mid-December, and most recently mid-February this year. I had for a while utilized this, and this is what made the channel unusual. I had for a while utilized this moving average as the upper bear channel line before I drew a proper upper trend line. Well, this week the market punched up through it, the first time pushing and closing over it since June last year. What is more, the market continues to rise, and yes, they punched up and closed over the upper bear channel line, highlighted in dark blue on my daily chart. The cap on the market was the mauve highlighted slowly declining medium moving average, currently at 48.71. However, this has not been enough, as today prices forced their way up over the medium moving average, only stopping at the significant 38.2% Fibonacci line of the March 2020 to April 2022 move at 48.95. Do not think that this may be all, as this 38.2% Fibonacci line is now under threat, and to be honest, there is a congestion area overhead between 49 even to 51.25, but there seems to be quite sufficient ammunition below to take on this overhead congestion, should the market choose to do so. Thus, this brings me back to the bear channel and some potential targets overhead. So a primary target X would be in the 49.65 area, an area that we've almost reached, with a secondary harder to reach target X1 up at 51.95 area.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.